Welcome to the Capital News. I am your host, Alex Karitis. Today is May 28th, 2019. Thank you so much for joining me. So the market's whipsawed today. We have the S&P closed down 24 points. The Dow Jones Industrial Average lost 238 points, representing about a 0.9% of a loss. The NASDAQ lost 30 points. The Russell 2000, the small cap index, lost 10 points, representing a decline of about 0.7%. The Dow Jones Transports, again, we're adding this to the mix because it is a forward-looking indicator. It's a leading indicator. This is the Dow Jones theory. This is looking at the transports. Remember, it takes transportation logistics firms to get goods from point A to B to C to D, right? So if they're slowing down, it seems to reason that the overall economy is slowing down. It makes sense. It has held up. It has standed and proved itself over the course of time, so it is something that we are going to be paying attention to here. So the Dow Jones Transports continued its decline and lost 132 points, representing a 1.3% decline for the day. Also, the New York Stock Exchange, we're going to add this to the mix on occasion because this is sort of the broadest aggregate of all of the indices. And it too shed 115 points, representing a 0.9% decline for the day. And you have to remember, folks, in previous conversations, the S&P and the NASDAQ have made new all-time highs. They did so recently. The Dow Jones has not. The Russell 2000 has not. The Dow Jones Transports have not. And neither has the New York Stock Exchange. So when we were talking about being in a bear market in the fourth quarter of 2018, because we saw a decline in equity prices of 20% across these indices, what could we be in the midst of now? A continuation of the bear market, but this is a bear market rally. And so far, that is pretty much held up because we have not had any type of blow-off rally, the sort of melt-up that was discussed here. This is obviously a theory that still exists in the market. It is one that could still happen. This is not off the table by any sense of the imagination, because we have here the possibility for a market melt-up. Remember, we were talking about Larry Fink, the CEO of BlackRock, a major investment firm, saying that's a possibility. He wasn't saying write it down, bet your firstborn on it, not at all. But it was a possibility. And we said, yeah, you know what, despite all of the economic news that we discuss here on a daily basis that is not, painting the prettiest of pictures, we're in the financial world of Oz, and there is some cash sitting on the sidelines, and it's in some other financial assets. And if it wants to rotate out of those other financial assets or get off of the sidelines, it may very well run into stocks. And there you would have your blow off top, your melt up in the stock market, not a meltdown. Still a possibility. Is that my primary scenario? No, it's not. But I do obviously have a bearish bias. I'll be honest about that, just because I look at the pieces of this economic puzzle that we have been piecing together for quite a while, and it is not painting a rosy picture. So you act accordingly. So I still have a bearish bias. I also look at these other indices, and I say, well, my goodness, with the exception of the S&P and the NASDAQ, the Dow hasn't made new all-time highs. The Russell hasn't. Dow Jones Transports has not. The New York Stock Exchange has not. So there's still a lot of work to be done. And, of course, we've been in the midst of another little sell-off, a little correction here over the past few weeks. So there's a lot to pay attention to. And, of course, we're going to go around the global equity market today because there's a lot to cover. We have oil. We have WTI at $58.89 a barrel. We have Brent trading right around $70 a barrel. Gold, we have a flight to sort of safe haven assets, primarily the dollar and U.S. Treasury bonds. So the dollar has strengthened. So we have seen some continued weakness in the precious metals market. So gold is right now trading at $1,279 an ounce. Silver was down about 1.5 percentage points for the day, and now trades at $14.34 an ounce. The U.S. 10-year Treasury took a beating. It is now down 2.4% for the day, its lowest in over a year and a half. It now sits at 2.268%. This is on the back of more people are now concerned that we might be in the midst of a recession, or a recession is really looking more and more likely. Well, no surprise. Where has everybody been? They've been in la-la land. They've been positioning themselves, perhaps. I don't know. But maybe they're finally starting to piece together this economic puzzle, which we have been piecing together here for quite a while, since this podcast has been on the air since early February. Nothing has changed my mind. In fact, I am more convicted. I have more conviction that this market is going to roll over. Now, we do live in the financial world of Oz. You never know what this president is going to tweet. You never know what the Federal Reserve is going to do. So you can have a melt up. You can. I hope that doesn't take place, but it very well could. I mean, I still have positions that are long. I mean, I'm not saying personally that I would do poorly from that. I would do okay. I have positions in this market that are still long the market, and if there was a melt up, I'd be a beneficiary of that. But I am not here to partake in all of this fraud, corruption, and abuse. I want markets to find fair value. And we are so far above fair value, it's not even funny. I'm telling you, at least, in my opinion, in my analysis, we are at least going back to 2016 levels. 2016 levels, which is fitting with the report from Ray Dalio and Company, the largest hedge fund in the world. Ray Dalio is the founder of it. It's Bridgewater Associates. The report that we read here on a previous podcast, maybe about a month ago already, discussing how they think that U.S. corporate profit margins have peaked. So if they've peaked, they only have one way to go, and that's down. And with those falling and those getting squeezed, they are predicting a decline of potentially 40% across U.S. equities. That is in complete agreement with what I have been stating well before that report came out, because a 40% decline will take you back to those 2016 levels, if not before. And that is minimal, in my opinion. I think it'll be worse than that, because this market has been completely rigged and fixed and bought and paid for by the Federal Reserve and by you, the taxpayer. You have been flipping the bill. This has been the largest wealth transfer in the history of the world, or most definitely one of them. And unfortunately, there's really no end in sight. Because while we may have been embarking on quantitative tightening, and I use that loosely, we now may actually be going back to quantitative easing by the end of this year. We may actually have interest rate cuts, because this economy, this stock market, is rolling over. So President Trump, despite his criticisms, and rightly so, when he was a citizen and a candidate, criticizing the government, criticizing the Federal Reserve and their fraudulent and flawed and really failed economic policies of cutting interest rates to extreme lows, zero interest rate bound, and embarking on quantitative easing, which is debt monetization. Nevertheless, the president is out there and sending his lackeys out there to say, hey, we need to cut interest rates. We need to go back to quantitative easing. Well, he may very well get his wish before this year's up. He may very well get his wish, but we're going to have to see what happens. If that does happen, you're really at the 50-yard line, and it could go either way. The markets could love it because they think, oh, we're getting another shot of heroin. This is exactly what we were looking for. We want our high, and lowering interest rates and embarking on another round of quantitative easing, that could be a big jolt in their arm. I think it'll be short-lived, because I think reality will start to set in. I think it's, oh my goodness, well, on one hand, we're told that everything is great. We still have some headline numbers that show that things are quote-unquote good. Of course, if you look under the hood, they're not. But of course, you can still run off those things from a headline perspective. You have, of course, the Q1 GDP figure of 3.2%, which is a complete farce. And we'll see that revision, and we'll see the numbers for Q2 here in the not-too-distant future. And, of course, we have some major banks, such as J.P. Morgan, recently out with their economic forecast for Q2 GDP, and it's at 1%. 1%. That's booming, baby. That's the best ever. That's all we can do, 1%. Now, they thought previously in the year it was going to be maybe 2, 2.25%, 2.5%. Now it's all the way down to 1%. That's more like it, J.P. Morgan. Now you're finally getting it. Maybe they're finally looking under the hood. They're not just paying attention to presidential tweets and White House lackeys. Maybe they're actually looking at the report and the numbers like we do here and say, you know what, something's not right. okay? But you never know. You never know, because that has fed these markets since the beginning of this year. Tweets from the president, tweets and statements from his lackeys, and statements and comments from the Federal Reserve and other central bankers around the world. So we got to pay attention to all this stuff because it's a moving target. So again, it will put us at the 50-yard line. Will it be a short-term boost if there are interest rate cuts, if there is another round of quantitative easing? Of course, there could be. But I think the law of diminishing marginal returns will kick in. I think reality will kick in. And I think people are going to say, you know what? I want my money. Because if the Federal Reserve is coming back in aggressively and doing both of those things, interest rate cuts and quantitative easing, then they're doing so because there must be an emergency on the horizon and they're trying to fend it off. And if there's an emergency coming, I might need some cash. And I'm not going to put it in stocks because I'm not going to be able to stomach the volatility. Again, there could be a short-term squeeze to the upside, but I don't think it'll be long-lived. I could be wrong. I always admit that I could always be wrong. But I honestly believe that this game is going to come to an end, and it's not going to be pretty. Because sooner or later, this stock market is going to have to come back to fair value. This stock market is going to have to look around the world, because this is not just going to be unique to U.S. economic growth. This is global, everybody. Pay attention. And corporations' stock prices are supposed to be predicated off of cash flow. Well, if you have no business because of slowing economic growth, then where are your revenues? Where's your cash flow? At the same time, mind you, you have a wall of several $1 trillion of corporate debt that's coming due over the course of the next 4 years. So you have slowing global demand, so your revenues are getting pinched. Your margins are going to get pinched because you got to start paying off this debt. Where's your cash flow going? Where are your profits? See what we're getting at here? This is why we've been talking about this since the very beginning of this podcast, because it ain't that difficult. You just have to look under the hood. You cannot just listen to the headlines. You can't just listen to politicians. And again, I was very, very hopeful that Donald Trump was not going to be this type of economic cheerleader, if you will, that he was not going to take title of this economy and of this stock market. That he was going to come in and say, I'm here to drain the swamp, baby, and that's exactly what I'm going to do. And we just got to sit back and take it. This is what we're going to do. It's not going to be easy. This is generations of fraud, corruption, abuse, nepotism. It's not going to be undone in 2 years. It's probably not going to be done in 4 years. Even if I have 2 terms, it's not going to be done in 8. This has to be a continuation. This is a work in progress. So sit down, buckle up, and get ready, because this is going to be an arduous journey. But we can do it together. Now, of course, he didn't do that. Despite his criticisms, and again, rightly so, when he was a candidate and when he was a citizen, he blamed the government, their artificial figures. He blamed the Federal Reserve. Rightly so. Now he's president. He wants to take title to the economy, to the stock market. He wants the Federal Reserve to go back and do what has destroyed this country. So I have a problem with this. Now, of course, it could be him dancing himself out of the box for taking title to both of those things, and now saying, well, look, I told the Federal Reserve, cut interest rates. Go ahead, do another round of quantitative easing. Because if this economy rolls over, if the stock market rolls over, he's going to say, look, I told them, they didn't listen to me. And now the stock market is crashing, the economy is slowing down, and now it's too little too late from the Federal Reserve. They should have listened to me when I told them 2 months ago. And he can get away with it. He can most definitely get away with it, because yesterday we were talking, I didn't do an economic podcast yesterday, but I did do one on the political podcast because I wanted to do the follow-up with my letter to the president and some of the feedback that I received on Facebook from obviously the general public. And I said, look, you got to be careful here with this cult of personality, just trusting this president blindly. And again, it's not just President Trump, it's any president for that matter. And I went after President Obama harshly as well. You cannot follow these people blindly. Everything they say, you just can't shake your head, nod your head, yes, sir, yes, master, everything's fine. You can't just do that. You cannot do that. It is a complete disservice to this country. You are supposed to question everything. You're supposed to question everybody. Question me on everything I say and write. Go do your own research. Open your mind. Don't just watch MSNBC. Don't just listen to CNN. Don't just turn on Fox. Go broaden your horizons. Go think, for goodness sake. It'll do you a world of good. So some other things that we're going to discuss here are some other leading indicators we think are leading indicators. And we discussed on a podcast not too long ago, and that was copper. So right now we have copper, which is trading down. It now sits at $2.69 a pound. So that's a little lower than where we were on that podcast where we were discussing that. We also have lumber, which is down about 6%. 6% in one trading day today, and now sits at $307.50 per 1,000 board feet. So this is something to pay attention to, because when you're talking about copper, it's an industrial metal. If it's pretty much associated with economic growth. There's a lot of construction, you need copper. Well, if the price is down, it sort of says, well, there's not that much demand for it. So not painting a pretty picture. And then when you look at the price level of where it currently sits and where it has been trading for the past 6 months, because if you want to look and be reminiscent as to where copper was trading only a handful of months ago, late 2018, early 2019, when we were in the midst of that 20% correction, bear market territory in the stock market, well, that's where copper was trading. That's where it was trading. Same is the case with lumber. It's another construction material. If you're building, you need lumber. It's that simple. That's all it is. Don't overcomplicate anything. And now, again, you are at a price level that we saw back in the fourth quarter of 2018. Do these materials lead the market? So when you look at these things in conjunction, again, not on its own. This is the economic puzzle that we have to put together. These are all the pieces, right? So if you're looking at copper, if you're looking at aluminum, if you're looking at lumber, if you're looking at the Dow Jones Transports, if you're looking at the New York Stock Exchange, and you're seeing that these things are not making new all-time highs, that they are back trading at levels, some of these things, particularly the metals and lumber, back to where they were in the fourth quarter of 2018, and then you look to see what happened in the markets subsequently thereafter, it wasn't a pretty picture. Are we setting up for the same type of scenario this summer? Will it happen next month? Will it happen in July? Will it happen at all? Again, we don't know what President Trump will tweet out. Oh, we got a deal. Everything's great. Fantastic. We're going to have a signing ceremony, which is what we were told for 6 months. None of that happened. But nevertheless, the markets rallied on it for 6 months. Get my point? This is why this is such a dangerous environment. This is why I wrote the letter. Because that is an abuse of power, because he knows he's manipulating these markets. Just say we're negotiating. That's all you got to say. Here are some of the finer points. We're going to Beijing. If they come back to Washington, that means things are fine. If we don't, then we got a problem. And here are some of the points. You don't need to take to Twitter to move these markets. He knows. He talks about the stock market all the time. He knows. CEOs can't take to Twitter and move their share price. It's a problem. The president should not be above the law in that. Nowhere in the U.S. Constitution in Article 2 or anywhere else where we, the people, vest powers in the president, is it stated anywhere that he is supposed to be an economic dictator or that he is supposed to be manipulating the financial markets. Nowhere in there. It's not his duty. It's not his responsibility. It's his responsibility to protect this country, to be the commander-in-chief. That's his job, not to take title and ownership of the stock market and the economy. It's just not his job. So I have a problem with it. And that's what the letter is all about. But nevertheless, those are the leading indicators we have to pay attention to, in conjunction with a whole host of other things. The inversion of the yield curve, which is continuing between the 3-month Treasury and the 10-year Treasury. I think it's just going to be a matter of time before the 2-year and the 10-year invert. And that'll sort of be the icing on the cake, because some people want to say, well, you really got to look at the 10-year and the 2-year. Other people think, well, you got to look at the 3-month and the 10-year. I mean, this is just really a bunch of nothing, okay? But nevertheless, you look at it. If you have one point, you can say, well, the other one hasn't cracked yet. Okay. Well, what happens when that one does? And then there's really going to be a tizzy. Then there's really going to be a panic. So we're going to continue to pay attention to that. Now, some of the other economic news, some of the other headlines that came out today, we have the U.S. home prices rise the least in 6.5 years. So we have the S&P CoreLogic Case-Shiller 20-City Home Price Index, that's a mouthful, in the U.S. rose 2.7% year over year in March. the least since August of 2002, after a 3% increase in February and missing market expectations of 2.6%. Las Vegas recorded the biggest increase, followed by Phoenix and Tampa, while the smallest gains were reported in San Diego, Los Angeles, and San Francisco. So if you're looking at some of this data, and if you're looking at the Case-Shiller indexes, there's a couple of them. There's the 20-city, which was referenced here. There's the nationwide, and then there's a 10-city. So here, if we're looking at the Case-Shiller 20-city home price index, if you want to go back just to provide some historical context to it, it peaked. The index peaked back in April of 2006, and the index stood at 206.6. That was the reading. In May of 2019, this same reading, the Case-Shiller 20-city index, now sits at 215.3. So there has not been a huge increase in this index. In fact, it only represents a 4.2% increase over the course of 13 years, from April of 2006 to May of 2019. So this has been the long journey of home prices getting back to where they were during, quite honestly, quite really just before the onset of the housing crisis and the financial crisis. Now, one of the things that you have to pay attention to, and if you look at this graphically, it's really the delta or the change in how quickly the index shot up prior to 2008, 2009, and how it peaked in 2006. That ramp up was very steep and very sharp, which led to the financial crisis. We do not have anything like that since the financial crisis. This has been a little bit more steady as she goes over the past 13 years. But nevertheless, because of the reflation and inflation trade that has been implemented by the Federal Reserve and the federal government, just, injecting liquidity after liquidity into the marketplace, this is where the money goes, folks. There's no inflation. There most definitely is. This is where it goes. It goes into financial assets, stocks, bonds, commodities, real estate. It just goes in these areas at different rates. Most of it went into stocks. A lot of it went into bonds. I mean, that's what it was supposed to do. That's where it went. It has also been making its way in the housing market, which we see. And it depends on where you are. Am I very concerned with the U.S. housing market? I'm not very concerned. I'm concerned, but not very concerned. I'm more very concerned with the housing markets in China, in Hong Kong, in Australia, in Canada. I'm more very concerned with those markets because I really think those are very much so in bubble territory, and they will eventually collapse, and with it their economies, and quite possibly another financial crisis the world over. Here, I've been talking consistently for the past several months that what I am anticipating will take place in the U.S. because most of the price increases have taken place on the upper end, the luxury end home building. I think what we are likely to see here is another housing event, another housing failure. I do not think it will be as bad as it was 10 years ago. I mean, that's a high hurdle, but there is going to be another one, unfortunately, and I think it's going to be a top-down, bottom-up, so it's going to be a squeeze. Before, it was really a bottom-up because it was all subprime, but now, because you're dealing with high-end luxury, you're really talking about prime lenders or prime borrowers, people with a lot of money that probably put too much money into these houses, into real estate, apartments, condos, whatever, and you're going to see the high end start to come down, which we have already been witnessing. And then as the economy starts to deteriorate with it, you will see layoffs start to increase because, again, you have slowing global demand, you have a whole bunch of debt coming due, you need to save costs. Well, where can you save costs pretty much immediately is in personnel. So you're going to see a whole bunch of layoffs. So that's going to put more pressure on people at the lower end of the housing market. So that's why I'm talking about a top-down, bottom-up squeeze this time as opposed to a simply bottom-up catastrophe from 10 years ago. So we have to be mindful of that and pay attention to all of that. Now, lastly, before we go, I do want to make a quick round around the world with some of the bigger markets. Right now, we have the Japanese markets, the Nikkei trading. They are down 246 points, representing a 1.16% decline so far. We have the British markets trading today. They were down about a half a percentage point. The German markets were down 0.8%. The French markets were down about a percentage point. The Italians lost about 0.1%, 0.2%, and the Spanish lost about 0.3%. So we have to pay attention, obviously, everything globally. One of the things one second, let me bear with me here, because I want to see what's going on right now in South Korea, because South Korea is a bellwether of what's going on globally because they're such a big exporter worldwide. Well, right now they're down 31 points, representing another 1.5% decline for the day. So that's not a pretty picture for the South Korean markets. And the Hong Kong markets are down another 125 points as we sit here right now, which represents about a half a percentage decline. But lastly, before I let you guys go, I just want to run this by you too, because this is more stimulus from you-know-who, the Chinese. So China's central bank said it will inject 270 billion yuan, that's roughly 39 billion US dollars, through 7-day reverse bond repurchase agreements. On a net basis, the People's Bank of China, the PBOC, will inject 250 billion yuan into the market for the day, as 20 billion yuan worth of reverse repos are set to expire on Wednesday. The amount of daily net cash injection via reverse repo operations is the biggest since January 17th of 2019, of this year. And this is something we discussed very early on in the genesis of this podcast back in February, because we were talking about record injections of liquidity coming from the People's Bank of China, along with major stimulus efforts from the Chinese government through further, obviously, stimulus measures like this, through tax cuts. This is not good. This is the Chinese economy, in my opinion, running out of steam. Do the markets like it on the surface, on the headlines of, yeah, they're stimulus, the Chinese, great, everything they do is fantastic because it's a state-run economy. Oh, we love it. We love state-run economies here in the West. I mean, this is, I can't even explain it. This doesn't make any sense whatsoever. We have been advocates and should have been advocates and should be advocates of free market capitalism. Of course, free market capitalism does not exist in this country, but nevertheless, we're supposed to be advocates for it. Now, we have state communism or state capitalism over there in China. 1.4 billion people, they solved the riddle. They can never fail. They will fail, and it will not be pretty. And I think all of these quote-unquote stimulus measures by the Chinese government, by the Chinese central bank, is a signal that things are not so pretty. They're not, folks. They are not. They cannot defy economic gravity forever. Another interesting to note, the huge injection of fresh funds by the PBOC after rises in interbank money rates that partly reflected nervousness that the takeover of a troubled regional bank by regulators could herald a possible weakening of small banks' ability to access interbank funding. So you thought the U.S. banking sector was a problem 10 years ago. You ain't seen nothing yet, because the Chinese financial sector, banking sector, it's on steroids. It's a true shame. It's a true scam. The government covers it up. The central bank is covering up, just like we do here. The government comes to rescue the banks, right? This is the banker's world. This is what they're doing. These are the signals you have to look for. These are the economic puzzle pieces that you have to look for in place to paint a picture. This is not a pretty picture. Will they be able to skate this? Maybe for a little bit, but not forever. Because if this starts to cause contagion, if this starts to cause a liquidity crisis, this is going to ripple throughout the entire world. And this has nothing, absolutely nothing to do with trade. Absolutely nothing. So get it out of your head. Trade is an excuse. If they wanted a trade deal for soybeans, futures, cattle futures, and a whole bunch of other crap, they could have done that last Tuesday. Okay? This is structural. This is a superpower, the United States, attempting to slow down a rising and up-and-coming superpower, the Chinese. That's what this is about. So this whole talk of all of this trade stuff, it's a bunch of crap. That's all it is. All right? But nevertheless, the markets are going to move on it. These are the things you have to pay attention to. These are the liquidity problems. These are the banking failures. And, people want to believe that because it's state capitalism, quote-unquote state capitalism from a bunch of commies over there in China, they can somehow get things done quicker that prevents contagion. Well, they're going to be in for a rude awakening. And that's why we're likely to see these equity markets around the world find fair value, and I hope it's sooner rather than later. But you have to be prepared. Build cash. Stay long some of these things. If you have a long time horizon, stay long because you can ride this out. You can ride this out, but also build cash because if and when this thing does come down and comes down significantly, it's going to be the sell of a lifetime, and you're supposed to buy low and sell high. I'll keep you posted. Thank you so much for joining me today. It's been a pleasure having you as always. Please like, share, subscribe, get the word out. Leave your comments. We do love hearing from you. This is the Capital News. I am Alex Kouraitis. Godspeed.